Parents, listen up. Your kids could be your biggest tax deductions in 2025. Now, whether you have a newborn baby or a fully grown teenager, you could be looking at massive tax savings. And in this video, I'm going to show you 5 proven ways that your children can legally save you thousands of dollars in taxes this year. All of that plus more on today's episode. What's up, family? Welcome into another episode of Tax Free Living. I'm your host, Carter Cofield, CPA and tax strategist extraordinaire. And today we're going to be talking about how your children can help you save massively on taxes. And I've compiled my 5 favorite strategies that your children can actually help you save on taxes, and you can help them build generational wealth at the same time. So without further ado, let's get into the strategies. Strategy number 1, the child tax credit. So this is the first and honestly one of the most powerful tax strategies. And the reason why it's one of the most powerful tax strategies is because the child tax credit is a tax credit, not a tax deduction. And if you're new to the channel, tax credits are way better than tax deductions. Let me explain. If you have a $10,000 tax deduction, you have to take that amount times your tax rate to understand your true tax savings. So if you have a $10,000 deduction and you're in a 30% tax bracket, you only actually save $3,000 in taxes. However, if you get a $10,000 tax credit, that is a dollar for dollar credit that will lower your tax bill. So a $10,000 tax credit would lead to $10,000 in direct tax savings, which is why I love the child tax credit, because it can quickly eliminate your tax bill. And in 2025, the credit is now worth $2,200 per child. This is the highest tax credit we've ever seen in tax history. And not only is it a $2,200 tax credit per child, but $1,700 of this credit is refundable, which means that if you don't have any tax bill, you can still get a $1,700 tax refund per child using this credit. Now, keep in mind very important things and limitations around the child tax credit. Number 1, the child tax credit is only for kids 17 or under. So if your kid's over 17, you will no longer qualify for this tax credit. Number 2, there are phase outs associated with this tax credit. So if you're single and you're earning $200,000, or if you're married earning $400,000, you are phased out from being allowed to take this tax credit. So when you're taking this tax credit, you want to take it when filing Form 8812 on your 1040. And here's a pro tip. If your income is close to the cutoff, the $200,000 single or $400,000 married, you can implement tax deduction strategies to help lower your income below this threshold. So you can consider making extra contributions to your 401k or making contributions to your HSA to stay within the full credit range. So for a family of 2, this credit alone could slash your tax bill by $4,400, which is substantial. Now that we've covered the broad credit available to almost every parent with a child 17 or younger, let's talk about more specific tax credits related to childcare. Because if you're paying someone else to watch your kids while you're at work, the IRS will actually help you cover part of that tax bill. So let's break it down. Number 2, child independent care credit. The child independent care credit helps offset the cost of daycare, after school programs, and even summer camps. And for 2025, you can claim anywhere from 20% to 35% of up to $3,000 of child expenses per child, or $6,000 if you have 2 or more children. So what does that mean? Well, that means for the credit itself, it maxes out at $1,050 for one child and $2,100 for 2 or more children. Now, one of the key concepts is, how do you make sure you properly record your expenses for this credit? Well, number 1, you want to keep the receipt. Number 2, you want to keep the provider's name and address and get their tax ID number. These 4 things are required to properly take this deduction on Form 2441 when filing your taxes. And here's the thing. If your job offers a dependent care FSA, which a lot of employers do, you can set aside up to $5,000 pre-tax in 2025. But keep in mind, every dollar that you put towards your Independent Care FSA reduces what's eligible for your Child Independent Care credit. So it's a coordination game, right? First, allocate money to your FSA and then allocate the rest of what's left to the credit so you can make sure you're maximizing the deductibility of your child care expenses. Now, as much as I love tax credits and how amazing they are, they only go so far. But what if I told you that you could actually move money out of your tax bracket entirely and move it to your kids' tax bracket where they can often pay low or zero taxes? This is exactly what happens when you put your children on payroll. And this is one of my favorite strategies to discuss. So let's break it down. Okay, hire your children in your business. If you own a business, you can legally hire your children for real work and deduct their wages on your business taxes. And here's the kicker. If you're a LLC or a partnership where either you or both parents own the company, wages to children under 17 are exempt from Social Security taxes, Medicare taxes, federal taxes, state taxes, and FUTA taxes, which is federal unemployment taxes. And if you operate an S corporation, you can still avoid these taxes, but there's a workaround that you have to do, which I'll explain in another video. So let's focus on my LLC or partnership owners. How does this strategy actually work? Well, number one, you need to assign your children an actual task in the business. And I prefer you also give them a job description for further audit protection. Now, your kids can do a lot of work in the business. They can be your assistant, they can take calls, they can manage your social media, they can clean the office, they can do a lot of things. We not only want to give our children a job description, we also want to track their time that they're going to be working in the business. And if you do this properly, the IRS will allow you to pay each of your children up to $15,000 per year, and you, the business owner, get a $15,000 tax deduction, and your children will receive this $15,000 100% tax-free. Now, why is that? Well, everybody gets a standard deduction of $15,000. So as long as you pay them less than the standard deduction, that money that you pay them will not be taxable. So that means that you, the business owner, gets a tax deduction, your children receive the money tax-free, and the whole family gets to keep more of the money. And in our firm, this is what we call an income shifting strategy. How do we move money off of your high 30, 32, or 37% tax bracket and move it somewhere else with a low or 0% tax bracket? And one of the ways that we do this is by effectively paying your children from your business. Now, I know the question that you're asking, Carter, I don't have a business. Are there still ways that I can turn my children into tax savings? And the answer is absolutely. And one of my favorite strategies is showing you how you can save for your children's education and save on taxes at the same time. What do I mean? Well, insert the 529 college saving plan. Now, the 529 plan is one of the most powerful tools that parents have. Why? Number one, the money grows tax-free. And number two, as long as the money is used for qualified expenses, the money can also be taken out tax-free. And number three, if your children decide not to go to college, you could transfer the money into a Roth IRA and allow it to grow tax-free forever. That's right, 529 plans just got sexy again. Okay, so let's break this down further. In 2025, you can contribute up to $10,000 per year per child, and this money can be used for educational expenses like kindergarten through 12th grade, or it can even be used for private school as well. So I love 529 plans because they don't have to strictly be used for college tuition. They can be used for other educational expenses as well. Now, the question is, how do you properly set this up? Number one, you want to open a 529 plan through your state or a major brokerage. Number two, you want to set up automatic contributions so you can set it and forget it, even if it's just $100 a month, because compound interest is one of the strongest forces in the universe. It's not about timing the market, it's about time in the market. Now, one thing I encourage you to do is to check your state's rules, because many states also give you a tax deduction for the money contributed to your 529 plan. So you want to check if your state is one of the states. But even if your state doesn't allow for a deduction, this still could be an amazing plan to help your children get ahead for college. And again, if they don't use the money for college or for educational expenses, this money can be rolled over into a Roth IRA that will still grow tax-free forever. So I think this is an amazing plan that every parent should be taking advantage of this year. So at this point, we've covered the child tax credit, we've covered child care expenses, we've covered income shifting strategies through paying your children from your business, and then we've covered education through funding a 529 plan. But there's one more area that most parents forget, and that is hiding your family's medical bills. So let's break it down. Number 5, medical expenses. If you itemize your deductions, you can include the medical cost you pay for your children throughout the year. The catch is that these expenses can't exceed 7.5% of your adjusted gross income. And that threshold knocks a lot of families out of the qualifications for this. But for those with high medical costs, the savings can be real. So how do you do this? Number 1, you want to track all the expenses that your family has throughout the year for their hospital bills. And not just hospital bills. We're talking about prescriptions, braces, glasses, therapy. And if your income is $100,000 and you spend $10,000 on eligible medical expenses, you can deduct $2,500, again, everything above the $7,500 threshold, $2,500 worth of expenses on your taxes if you itemize. Now, I know this is unlikely, but it's often overlooked. But when it applies, it can apply in major ways for families that qualify. So here's the thing, whether it's credits, whether it's childcare, whether it's hiring your kids, whether it's saving for college, whether it's deducting medical expenses, your children can literally become your biggest tax strategy in 2025. And we have 3 months as the recording of this video left in the year to maximize our deductions so that we can minimize our taxes. And with proactive planning, you can be able to save money in your business as a parent and be able to help build generational wealth for you and your family at the same time. And this is what this channel is about. It's about tax savings, but it's also about wealth building, because I don't believe you can have one without the other. So if you want to see how much your family could save by implementing these strategies, hit the link in the description below and you can schedule a call with my team and we can map all this out for you before tax season so we can help you during tax planning season so you don't have to worry about paying taxes during tax paying season. Again, click the link in this video to book a call and we can't wait to help you this year. Other than that, see you all next time.